Paul Slaviero from Momenta Advisors. Thanks very much for joining me today. Tell me a little bit about yourself and what Momenta Advisors do.
Yeah, sure. And no, good afternoon, Jaden. Thanks for reaching out to connect today. So, as probably the name suggests, we're advisors. More so specifically, we're accountants. We specialise in tax compliance, business advisory, and business services as such. I'm a partner here at Momenta. We have 3 offices around Sydney, and we specialise in, like I said, sort of accounting, but more of a proactive approach to accounting. Our clients range from all industries and businesses. You've got your small to medium businesses, you've got your mum and dad businesses, you've got your high net worth individuals, etc. So we don't specifically focus on one particular business or industry. It's quite broad, which allows us to be better advisors as such.
Yeah, nice. You mentioned proactivity, there a couple of times, and it's tax planning season at the moment, and I know you're right amongst it. And I said you've got a very scary meeting per day frequency at the moment. But yeah, for individuals, business owners, why is a tax planning meeting important with your accountant? And talk us through, what does a typical agenda look like for one of these meetings?
Yeah, perfect question. And as you mentioned, we're approaching 30 June, so we like to meet with our clients before the financial year ends. It's probably the most vital and valuable meeting we have with our clients. We tend to start these meetings around April, May every year. And what that allows us to do is have a good amount of months of trading, if we use a business as an example, throughout the year. So let's just say we meet in May. We've got 10 months of actual trading. We then forecast the remaining 2 months to 30 June, which allows us to do what? It allows us to do a few things. That's one, we get to forecast what that tax liability might be for our clients. And what that allows us to do is to say, okay, well, we're anticipating your tax bill to be X. That's not going to be due and payable for 12 months from there. What can we do in that 12 months to start planning? So if we know what our tax liability is, we know how much we need to set aside for tax, and then that'll allow us to say, okay, well, we've got still X amount in the bank. We can, go bring on more staff members or go buy more equipment, etc. What's important that we are meeting before 30 June, and like I mentioned, we give that gap of a month or two before 30 June, is then what strategies can we implement before 30 June to minimise our tax or to defer our tax. So, we're advising in real time. If we were to meet after 30 June and we said to our clients, you should have went and bought that equipment, or you should have contributed to super, their response is, why didn't you tell me? Exactly. Yeah. So we're proactively pushing our clients to meet before 30 June in order to forecast taxes, work out strategies on how to reduce that, but also just to do a bit of an overall health check for our clients. Are all our lodgements up to date? Are all our supers up to date? What does the current structure look like? Do we need to implement any other structures before 30 June? A perfect example of that would be if there's a trust involved and we need to set up a bucket company as part of their investment strategy, or even converting an individual from a sole trader to a company. Well, we can do that and be ready by 1 July to roll that out.
Yep. A lot of what you mentioned there may be more applicable to, business owners, but one thing that, business owner or an individual employee is super contributions.
Yeah.
So superannuation is a bit of a tax haven. As financial advisor, it's a favourite of ours.
Yeah.
There's a range of different superannuation strategies that can be utilised to, minimise someone's tax. Obviously, now while we're earning income, but then also come retirement much later down the track where we can get that very favourable tax-free income rate.
Sure.
Something that's come in the last 5 or so years is the carry forward concessional contributions. Can you tell us a little bit about what they are and how you're using them with some of your clients in your tax planning meetings at the moment?
Yeah, and it's a great point to raise, because it is a focus point in our tax planning meetings. Is do we look towards doing and contributing extra to super. As you mentioned, there is the carry forward or unused contributions cap where you can actually go back 5 years and contribute into super for any amounts that you've missed in the previous financial years. Currently, at the moment, we are in the 24 financial year. The ATO allows us to go back 5 years, so being the earliest of the 2019 financial year. So just keep in mind, and I'm sure you're communicating this to your clients as well, this is the last year that we can go back to 2019 to contribute. As you're aware, and as I mentioned, I'm sure you communicate to your clients, there's obviously a eligibility criteria. It's not for everyone, and not everyone can access these unused caps. First one being your super balance needs to be less than 500K at 30 June of the previous financial year.
Yep.
And also, in order to go back and utilise a previous year cap, you must first utilise the current year cap in full. Yep. So, we keep using these word caps. We obviously are referring to the concessional cap, which is currently at 27.5K. So we must use the 27.5K in full for FY24, being this financial year. Then anything over that, it will carry back to the earliest of the 5 years, being 2019 for this financial year. In that example, let's move forward 1 year. We're in the 25 financial year. Then the earliest would be the 2020 financial year.
Yeah, awesome. Sounds like, there's another potential range of strategies there available to some clients. If we look forward and are planning, for tax over a number of years rather than just this financial year now, you could really use that rule to your advantage if you've got, potentially an investment property that you're looking to sell with a large capital gain. By banking up some of those unused concessional contributions for a number of years, so long as your balance, as you said, is under 500 grand. You can potentially really use that to your advantage and offset the tax that otherwise would be payable on a decent asset.
Yeah, absolutely, and it's a good point, and I think this is where going back to my earlier comments around why tax planning is so important. We are finding out, or if we already know, our clients had a large capital gain earlier that year from the sale of an investment property, for example. They're probably not aware unless we've told them before about these, additional contributions. So, we were able to catch that before 30 June, work with the financial advisor and say, yes, we can do that. Let's implement X. And then, we've saved them X amount of tax as well.
Yeah, it helps to be proactive, that's for sure.
Yeah. And probably to that point, it also helps with potential future investment strategies as well. So, it gives the flexibility to get more into super. If, for example, they want to buy a commercial property for their business, we save the tax on the way in. And then it also allows them to beef up their balance as well in order to potentially, acquire assets within their super fund.
Yeah, I would so love to turn this into a chat just about superannuation and that's all, because I feel like I'd really shine in that sort of environment. But I'll try and keep the spotlight on you and what Momenta does.
Sure.
Yeah. And then the federal budget, so that was handed down just last month. Was there anything new in there that you found yourself, sort of bringing up and discussing with your clients in these tax planning meetings? I know from, my interpretation of it was probably one of the most boring federal budgets we've had in recent years, and that's as a person in finance, I usually find them pretty exciting.
Yeah. I think you hit the nail on the head there, where it was quite vanilla, budget. There wasn't anything too exciting that jumps out, and we're excited to explain to our clients we can do X, Y, Z. Look, some of the highlights, if we were to focus on sort of a tax perspective, let's look at businesses, for example. The instant asset write-off has been proposed to be extended for another 12 months to 30 June 2025. What does that mean? Well, the current threshold for this financial year is 20,000 per asset. So to provide a bit of context of what that means is, if you were to buy an asset and you're a small business and that asset costs less than 20,000, we get to claim the tax deduction for the full amount, as opposed to depreciating that over a number of years. If you recall, post COVID, the ATO came out and abolished any limits as such. So they obviously wanted to stimulate the economy, get cash back into it. So there was no limit on assets that you could go purchase. So that was a fun time. That was a fun, exciting conversation we're having with our clients, where they'll go buy a fleet of equipment, cars, excavators, office fit outs, whatever it may be. Now it's toned down to the 20 grand threshold, but it is currently legislated that it was going to drop back to $1,000 next financial year. So it has been proposed to extend that for another 12 months at the 20K threshold.
Yeah, awesome. And as you said, that really helps. If you know you got that up the sleeve and there's big tax bills that might be paid this year, you can bring forward some of those asset purchases, as you mentioned earlier.
Yeah, exactly right. And then probably touching on sort of individual taxpayers, it's just the implementation of the stage 3 tax cuts. So that comes into effect from 1 July 24. We'll see the real tax savings in our 25 tax returns. What does that mean for the standard taxpayer? For example, if I was to throw out some numbers there, if you were to earn around 90K, that's around a 2K tax saving per year. If you're a high income earner earning above the 190K threshold, then you'll have about a 4.5 grand tax saving.
Awesome. Let's throw that in with the $300 off the electricity bill, and it's looking all right for next year.
Well, it's half a holiday.
Any particular areas that the ATO's come out and said, these are areas of focus of us for, this financial year or these rounds of returns?
Yeah, the ATO has recently come out. First, I heard it was on the news before I even got the notifications from the ATO. Now, it's probably nothing new than what it was the year before as well, but there is a big focus point on rental properties or investment properties as such. The ATO came out with some data saying that 9 out of 10 investment property schedules in a tax return were incorrect. So obviously a very high percentage there. Whether I believe that or not, well, we can say that for another conversation off the record. But there is definitely a focus on the deductions specifically for investment properties. If I were to throw out some examples, which is some examples that we see that we're having that regular discussion with our clients about, is maybe the characterization of repairs and maintenance versus capital expenditure.
Sure.
So there's always that scrutiny around that. So just making sure that we get that right, because it will be a focus point for the ATO to ensure that those expenses are treated correctly. Throwing out some examples, what would constitute a genuine repair? Let's say we break a window and we're replacing that window. So we could say that's a repair as such. However, if the aircon was to break down, for example, and you had to replace the aircon, well, that's not just repairing the previous one. We're replacing it with a new unit, for example. There's specific rules where we have to depreciate that asset over a number of years because the cost is more than $300.
Okay. Yep. Obviously, with all that and, doing our tax returns every year, we've got an obligation to keep pretty good records. And I know there's probably a spectrum of people where the majority sit at one end. They're pretty good. They get a receipt, they store it in a shoebox, or maybe they've got a OneDrive or Dropbox these days. It's neatly organised by tax year and what type of deduction. I don't know how many of the clients of those you've got, but it seems like there's a lot on the other end of the spectrum that just seem to... I'll gather whatever the receipts I can refine come 15th of May when I've got the meeting with my accountant. But do you have any tips or tricks, for clients that, might find staying organised around tax a little bit difficult? I know there's a lot of, proliferation of apps out there these days. But yeah, are there any specific ones that you work with or things you've seen clients do that can help them really stay on top of the record keeping side of things to make tax time as easy and pain-free as possible?
Yeah, sure. Look, hopefully gone are the days where we receive a shoebox of receipts, which I could probably only count on one hand the amount of clients that are our clients that come in with that. So, I feel like we've ticked a box on our end in educating our clients there. But
I must admit, I was one of those clients 10 years ago. I had we used to have Nike runners and footy boots, and I'd always keep a box of those for all my tax receipts for that year.
yeah.
I think I might even still have one box. I think it's been more than 7 years, so I can probably get rid of it too.
Yeah, exactly right, mate. But look, it's good for memories anyway.
Yeah.
So look, I think just like breaking it down and simplifying things, it's always easier to keep track of your expenses throughout the year rather than waiting to 30 June or end of the financial year and going back through emails and so trying to find receipts, invoices, or going through bank statements and everything. So definitely trying to keep track of your deductions throughout the year. And as you mentioned, there are a lot of tools and apps around at the moment that will allow you to keep track of that throughout the year. One being the ATO app. The ATO app, it's simple. The My Deductions tool within that app allows you to take photos of the receipt, to label what the expense is, and then you get access to that at the end of the year, which again you can export to your accountant, or it uploads to MyGov if you're doing your own tax return, etc. So definitely explore those type of apps. But look, if you're not so much on on your phone, and you don't need to take photos of your receipts, etc. You mentioned before, just keeping a neat file on a OneDrive or a Dropbox, specific financial years, and then as and when you receive a receipt or an invoice, just drag and drop it, and then you can provide that to the accountant at the end of the year, and they can sort it, put it into a summary with an Excel. Anything to help you keep track of things throughout the year, I think it's definitely worth exploring. And that's more specific for individuals. If you're a small business or you've got a bit of a side hustle, explore accounting softwares. Your Zeros, for example, where the subscription, for a basic subscription might be $30 a month, but you're keeping track of all your expenses all in the one software, which the accountant gets access to, or you can export reports. You can upload the receipts and invoices in there, and it stays there indefinitely.
Yeah, no, some really, really good information there and ideas. And you mentioned Excel, and I feel like for a lot of people, there's still no replacement for the old trusty Excel spreadsheet, which, again, I've got a proliferation of Excel spreadsheets for all the different tracking of taxes and investments and everything else.
I still think it's one of our most powerful tools that we use on the daily. And, easier to get an Excel out on a laptop in a meeting than to have a calculator these days. So and look, I always just say don't try to overcomplicate things with your tax affairs. Keep it simple. The biggest thing when you're looking at claiming a tax deduction as such is just to ensure that you've meeting the 3 golden rules from the ATO. It's one, make sure that you've spent the money yourself and you're not reimbursed. The expense is directly in relation to your income. And then thirdly, you've got a record or a receipt as such to prove that expenditure.
Perfect, mate. I think the 3 golden rules from the ATO would be a perfect place to wrap that one up. Paul, thanks very much for your time. It's Momenta Advisors again. If anyone's looking out for you, feel free to contact the team at Cruise. We've got all Paul's details and can share them with you as well. But yeah, thanks again, Paul. Really appreciate it, mate.
Thank you, Jaden, and enjoy the rest of the financial year. We're nearly there. 30 June's just around the corner.
Thanks, mate. Enjoy.
Cheers. Thanks, mate. Bye.